So what if I told you that the secret to building like massive resilient wealth is deliberately buying assets that you know will hardly make you any money?
Right, which sounds completely backward.
It really does. But welcome to the deep dive. Today we're looking at this highly reflective financial essay. It's titled, I No Longer Seek the Best Asset.
Yeah, and a mission for today is to really unpack this massive psychological and structural shift that the author details in their notes.
Exactly. Because for you listening, whether you're, a seasoned professional, starting a young family, or just getting into investing, you are definitely bombarded by all that get-rich-quick hype.
Oh, constantly.
So this deep dive is kind of a shortcut, a way to escape that financial FOMO and move toward a highly functional, resilient financial structure.
And to do that, we have to completely dismantle how most people view their portfolios. The author argues that we need to stop viewing investments purely as these profit-generating machines. Instead, a mature portfolio is really a comprehensive system of protection. It's an interlocking mechanism designed to maintain your purchasing power.
Yeah, to offer some actual structural flexibility in a world that is just fundamentally unpredictable.
Okay, let's unpack this right away, because searching for the best asset is, well, it's like searching for the best tool in a hardware store.
That's a great way to put it.
Right. Like, you wouldn't walk in and call a hammer the absolute best tool if your job is to cut a piece of wood.
No, you just ruin the wood.
Exactly. It's all about what the tool is supposed to do.
Yeah.
A chainsaw is amazing for cutting trees, but terrible for driving a nail.
But before we understand the toolbox, we kind of have to understand the pain of using the wrong tools. The author starts with a really vulnerable admission about this.
Yeah, they used to be entirely obsessed with growth, right?
Completely. For a long time, they were exclusively attracted to assets with the highest possible growth potential. They built a portfolio out of high volatility, aggressive growth instruments.
Basically a toolbox full of just chainsaws. Exactly. Just chainsaws running at all times. Which means when the market inevitably chops around, your net worth swings wildly.
And that has to be exhausting.
It is. The author writes about the sheer emotional exhaustion of riding that roller coaster, watching their wealth aggressively swing up and down day after day.
But the turning point wasn't like a catastrophic loss or a big win, was it?
No, it was surprisingly boring. The turning point was buying their very first bonds.
Wait, bonds? Seriously?
Seriously. Buying those bonds triggered this huge psychological revelation because when they bought them, there was zero expectation of massive life-changing profit.
You're just so funny to think about.
Right. But instead of feeling disappointed by the lack of an upside, the author notes this immense feeling of calmness.
Okay, wait, I have to push back here. Isn't the whole point of investing to make as much money as possible? How can deliberately not expecting a big profit actually be a good thing?
Well, what's fascinating here is the psychological shift. We're conditioned by bull markets to think a healthy portfolio is just the fastest growing one.
Because that's what everyone brags about online.
Exactly. But the author realized that investing over a lifetime isn't a sprint. It's really about survival. The real challenge isn't just making money, it's protecting the fruits of your hard work so it actually retains value.
Right, because if your aggressive portfolio drops by 50%, you don't just need a 50% gain to get back.
No, you need a 100% gain just to get back to zero.
Wow. Yeah, that math hurts.
It does. When you are 100% allocated to aggressive growth, you have absolutely no shelter. Bonds provide that structural ballast.
So you can't excel at the absolute bottom.
Precisely. And they also started using mutual funds for a similar reason, just to stay invested without the anxiety of monitoring daily stock charts.
So once the author realized that boring has all this immense value, they kind of had to unlearn everything, right?
Yeah, all the fundamental questions they used to ask,
Hmm.
like what's the best investment? Or what brings the most profit?
Because the winner is always rotating.
Exactly. Those questions assume the market is static. But capital flows in cycles. Sometimes the winner is gold, sometimes it's stocks, sometimes the US dollar, sometimes bonds.
So there are no permanent answers.
Right. Consequently, the author completely stopped looking for the perfect asset. They started building a combination of assets based on very distinct functions.
Like liquidity, protection, stability, and growth, which here's where it gets really interesting to me. It's exactly like managing a sports team.
Oh, like that. Go on.
Like if you only buy star strikers because their stats show they score the most points, your team is going to get absolutely crushed.
Because you have no defense.
Right. You desperately need defenders and a goalie whose only job is to stop the ball, not score. You wouldn't yell at your goalie for not scoring goals.
No, you'd be thankful they stopped the other team from scoring. And that connects perfectly to what the author realized. Investing is actually about building a system.
So it's pivoting from how fast can I profit to is my financial structure strong enough to survive?
Exactly. So if every asset is a member of the team with a specific job, we should probably pull out their resumes.
Let's do it. Let's look at the 5 specific asset classes the author lays out, starting with the strikers, I'm assuming.
Yep, stocks.
Yeah.
Their job description is long-term growth. They are hired to beat inflation and slowly build wealth.
But with a huge caveat, right?
Oh yeah, the accepted caveat is high fluctuation risk. You sign up for turbulence when you hire stocks.
Okay, so what about gold?
Gold is your goalie. It's not for getting rich quick. Its job is to maintain value, act as an inflation hedge, and basically just survive when global uncertainty spikes.
Think about how much stress that removes for you as an investor. Instead of panicking that your gold isn't doubling in price, you can just nod and say, cool, it's just doing its job of being stable.
That is the exact mindset shift.
Okay, what's next?
The third is Forex, so foreign exchange. And the author looks at this specifically from the perspective of someone holding the Indonesian rupiah.
Ah, okay. Local currency risk.
Right. It acts as a direct hedge against the local currency. If the local economy struggles and the rupiah weakens, holding foreign currencies like Singapore dollars or US dollars provides a crucial buffer.
It's like regional flexibility. You aren't totally anchored to just one country's problems.
Exactly. Which brings us to the fourth asset, global ETFs.
So expanding the playing field entirely.
Yep. They provide international diversification, US dollar exposure, and access to global economic growth. It ensures you aren't just relying on your domestic market.
And the final piece, the defenders.
Bonds. Hired for stability, fixed income, and heavily reducing the overall volatility of the entire portfolio.
If we connect this to the bigger picture, the math here is actually beautiful. When local markets drop, your global ETFs run. When stocks drop, gold stays stable.
And that's the point. The purpose of this diversification is not to maximize profit. It is fundamentally to reduce the risk of total ruin.
Right, and I have to push back here. So logically, assigning these jobs makes total sense. But practically, it means battling FOMO.
Oh, the fear of missing out is the hardest part.
It's so hard. The author even admits they were tempted in the past by, Samagoringen, those pump and dump stocks.
Yeah, market hype and quick profit stories are incredibly seductive.
But it's easy to say, ignore the hype on paper. How do you realistically maintain that calmness when it seems like everyone around you on social media is making a killing on some random viral trend?
This raises such an important question. And the author realized that those get-rich-quick mentalities are just too aggressive. They're highly emotional and basically impossible to sustain long-term.
Because eventually the music stops.
Exactly. So the massive breakthrough for the author was accepting that not all years will be good.
That's a tough pill to swallow.
It is. They used to expect their portfolio to always be green and growing, but they learned to accept red years, slowing economies, and stagnant portfolios as a completely normal part of the journey.
Which completely redefines what wealth actually is.
It really does.
Yeah.
Because they used to think wealth was about looking successful, right? Having expensive things, flaunting a luxury lifestyle on Instagram.
Oh, for sure. The invisible tax of trying to look rich.
Right. But now, they view wealth purely as the ability to stay calm and survive when crises hit.
Wow. Yeah, quick wins are so emotionally exhausting.
They are. True resilience brings this invisible, un-Instagrammable peace of mind, the ability to endure hard times that is the actual wealth.
I love that. And to bring this all together, the author's current status is really refreshing. They admit their portfolio still isn't perfect.
No one's is.
Right. They are still learning, evaluating, adjusting. It's built on small, consistent decisions rather than dramatic bet-it-all moves.
It's a continuous process of matching the right tool to the right job.
Which perfectly leads to the author's closing quote. They wrote, "I am no longer looking for the best asset. I am looking for a combination of assets that complement each other."
That really sums it all up.
So for you listening, true financial peace isn't about outsmarting the market. It's about outsmarting your own impulses and giving your money clear, distinct jobs.
And, it leaves you with a really profound thought to mull over. If the ultimate goal of accumulating assets is actually just peace of mind,
Right.
Could it be that an everyday professional with a perfectly balanced, utterly boring portfolio is actually richer in the ultimate currencies of time, sleep, and low stress than a billionaire who is constantly panicking over highly leveraged, volatile assets?
Oh, that is such a good question. Who is actually wealthier in the end? Something to definitely think about the next time you're tempted to chase the hype. That's all for today's deep dive.